Good morning, everybody. Welcome to Windsor Brokers Live Daily Market Outlook for Thursday, 7th of February 2013. A busy day ahead of us. Some action already started at the beginning of European session as the markets were rather quiet during the Asian trading hours, expecting, of course, the key events of today, releases of European Central Bank and the Bank of England rate policy and the monetary policy with wide expectations seen on keeping on hold. ECB President Mario Draghi is facing a heat over the European Central Bank sensitivity to the euro's sharp rise and his connection to an Italian banking scandal at today's meeting of European Central Bank. ECB is almost certain to hold interest rates unchanged for now. The reminder, it's the scandal over the third biggest bank in Italy, Monte Paschi, that produced some 730 approximately million euros loss in some transactions, while at that time Mario Draghi was the president of Italian Central Bank. The euro holds a rather positive tone on the overall picture, with still a negative structure seen on the current pullback from yesterday's first of February's fresh peak at 137.10. Correction lower so far found support at 134.58, but still could be seen in a larger picture as a corrective pullback, while regain of 136 requires is required to improve the hourly structure. As we can see, the pair is rallying higher now at the beginning of European session, with the central bank release being the main focus for now. As we said, the banks are overall widely expected to stay unchanged during this meeting, and basically most of analysts expect no easing in the monetary policy of the eurozone for until at least July 2014. As current situation, despite some positive signals of recovery of the European economy, still require the current ultra low monetary policy. Of course, there is still room for further easing. As we said, these are the most important events from among the others that we have basically the full calendar today. Unemployment rate that came from Australia, quite supportive, good news. I mean, unchanged. The interest rate is unchanged at 5.4%, but expectations were 5.5% in January. Employment change shows adding 10.4 thousand new jobs, much better than forecasted 6.1 thousand, and the draw of 5.5 thousand in the month of December. Leading indicators from Japan, just briefly to take a look, came better than the November's one, that was 92.1. 93.4 was released for today, below the expectation at 93.8. Consumer climate in Switzerland for the first quarter improved compared to the Q4 of 2012. That was -17, and -11 was the forecast. -6 is today's still negative, but shows improvement compared to the last quarter of year 2012. A trade balance of France that came out recently shows further widening of the gap to -5.3 billion euros compared to 4.3 billion in month of November, and 4.2 billion gap forecasted for today. Foreign currency reserves for January in Switzerland remain mainly unchanged, 427.08 billion Swiss francs compared to 427.2, slightly below the previous release of December. Still to come, a number of important data. Industrial and manufacturing production from UK due at 9:30. Improvement in both forecasts seen at 0.7% for manufacturing and industrial. compared to manufacturing was last reading in November at minus 0.3% improvement, while the 0.3% was the previous release for industrial production. UK trade balance due at the same time for December shows the slight narrowing of the trading gap to 8.9 billion sterling compared to 9.2 billion sterling gap in the month of November, following the industrial production from Germany at 11 o'clock GMT. No changes seen for today, 0.2%. And then the first of the two central banks, Bank of England, with their MPC rate decision that, as we said, is widely expected. It's expected to stay unchanged at 0.5%. Also, the asset purchase facility so far being unchanged for in past few meetings of the MPC at 375 billion pounds. The European Central Bank follows 45 minutes later at 12:45 GMT, also expected to stay pat at 0.75%, while the more significant will be press conference of Mr. Mario Draghi at 13:30, where we will have some more clues about the further steps. Wide expectations are further dovish comments from ECB president. Of course, he will be under pressure regarding the scandal that we mentioned from Italy and the current quite high single currency against the US dollar. From America at the same time at 13:30, data that come at unemployment weekly jobless claims basically are due at the same time. 361,000 new claims, slight improvement compared to the previous release of 368,000. We are back to the levels approximately 360 after 2 weeks posting record lows at around 330,000, showing slight improvement, but it seems that job sector in the United States is still a very painful point, and a lot of work is required to improve it, as the United States officials expect to drop the unemployment down to 6.5%. This is the required level. Preliminary non-farm productivity for the fourth quarter is expected to dip significantly. Minus 0.8% is the forecast compared to 2.9% in the third quarter of 2012. While unit labor cost is expected to go higher by 2.8% in the fourth quarter compared to draw of 1.9% in the third quarter. Building permits are from Canada are due at the same time, and great improvement compared to quite a negative release of month of November, where the reading was showed a minus 17.9% decline in the releasing new building permits, while the improvement seen in the month of December by 4.3%. New home price index in Canada for December at the same time 0.2% forecast had versus the 0.1% of month of November. There is a slight change according to expectations, and basically that will be the most significant releases for today from Europe and America. A current account from Japan due at late afternoon is expected at 0.24 trillion yen in December compared to 0.23 trillion Japanese yen in the month of November, and this is another significant release that comes in Asia that will be already in our tomorrow's business. So main focus in today's economic indicators is on the European Central Bank and the Bank of England, the monetary policy and the rate decision releases, of course, with industrial productions and non-farm payrolls, the new weekly jobless claims, I do apologize, in America being also the top releases. And look at the technicals for the major currencies and commodities to see where we are standing now and what are the expectations for today, starting with the single currency. If we start with the Ichimoku studies, then we show that the 4-hour structure is improving now, as the recent dip was broadly contained by ascending 4-hour Ichimoku cloud, and the Ichimoku cloud at top generally contained the dips. There was slight penetration inside, but current rally moves above the cloud, that is initial bullish signal, also break above the Tenkan Sen the Tenkan Sen line that is currently at 135.43, with the next barrier at 135.84, which is scheduled Sen, and the static barrier at 135.96. These are the lows of highs of yesterday. We have Ichimokus are giving initial bullish signal that the immediate risk of the further easing and the possible break below 135 and the more significant 134 test of more significant 134.58 is averted in the near term, of course, and a lot of work requires on the upside in order to confirm this theory, as break above 136.00 is a static barrier is required to signal some stronger recovery, and of course the break of Tenkan Sen above Kijun Sen moving averages that are still in the inverse mode. The faster one is still below the slower one, required to break above to confirm this current situation. Hourly studies are now improving, gaining fresh momentum, and shifting focus basically from 135 that was seen during the Asian session and early hours of European session, where the market basically dipped to 135.02. Now the focus is shifted to 136, our initial barrier. These are the yesterday's highs, approximately 135.95.96 to signal some stronger recovery. From Fibonacci levels, these highs is between 50 and 61.8% retracement, and if we see the break above 136, then a good confirmation will come on a break above 136, 1520, let's say, which is at 61.8% retracement of the down leg from 137.10 to 135.84. That will avert immediate downside risk and push the price towards the upper barriers. We have 136.51, which is 76.4% retracement. One of the previous highs at 136.74 as a minor resistance, and the key one is 137.10. 4-hour structure holds positive tone despite the current congestion here. The price holds above 20 days exponential moving average and moves toward the upper Bollinger Band of 30 days, which is currently at 136.78. This is approximately 76.4% retracement, as dip's recent reversal was contained at 38.2% retracement of the uplift from 130.37 to pardon 137.10. More focus still seen towards the upside. Underlying bull trend is still intact despite the brief break below the trend line drawn of 130.37 through lows at 132.64 and 132.85 that was dented in past 2 days pullback from 137.10, but current return above the trend line sees potential for a further extension and basically keeps the overall bullish tone still in play. As we can see, all indicators are still pointing higher, and see more potential towards the upside, as break above 137 is expected to open 138 as psychological and round figure resistance, and then 138.32, which marks 61.8% Fibonacci retracement of the larger down move from 149.38 peak of 2011 to 120.42 low of July, low of 2012 posted in July. Break above 200 days, weekly 200 days moving average that currently stands at 135.28, and yesterday's close above this level keeps the focus on the larger picture still towards the upside, as all indicators are also pointing higher. From the other side, the British pound remains under pressure. Brief consolidation is seen above yesterday and the 5th of February lows at approximately 156.30, but the pair still unable for some stronger action. Mainly the gains were capped at approximately 156.78. These are also the previous lows, and this is also the descending 55 days exponential moving average on the 4-hour chart. brief spike through this level was seen at the beginning of today's European session that retraced approximately near 38.2% of the latest down leg from 158.04 down to 156.29. Still a lack of momentum is evident at this point, as our indicators are still in the negative territory, and the quick reversal from the recent peak at 156.93 still sees the downside vulnerable. Basically, we have the initial barrier at approximately 157 level that marks near 38.2% retracement, and this is also the 4-hour chart, 20 days exponential moving average, and it's also the 50% Fibonacci expansion of the down leg from 158.04. Anything, any move, a stronger move above 157.00 barrier would be seen as a brief corrective action, and would not have a stronger impact on the broader bullish structure, bearish structure, as long as our key near-term barrier at 158 stays intact. Any break above 158 is to signal some stronger recovery and avert immediate downside risk of extension lower, as break below 156.30 is expected to open our next target at 156 zone, where we have the psychological round figure support and the Fibonacci 100% expansion of the latest move from 158.04 high of 5th of February 2012. As said, overall bearish tone that persists on the daily chart still sees the downside firmly in focus, 156.00, and at the later stage, in case of break lower, we would be looking for test of 155.30 that marks 76.4% Fibonacci retracement. Since we are in the larger picture, I have to point also that the range trading established from September 2012 has ended its phase on a break below 158.26 that marked the range floor, and now the fresh bear leg has commenced from there. We are looking for a possible extension down towards 155.30, 155. If we take the wave principles, then we are in the fifth wave from 163.80. The first one was 163.80 down to 159.91. The second corrective up to 161.77. Then the third one dipped to 156.73. Corrective fourth one ended at 158.77. And according to the length of the first one, the fifth one could travel down to 155.30, 155.00. I think around 155 is exactly the figure. Keeping the bearish tone still in focus. Quick look at the Ichimoku studies. Firm bear tone seen on the daily chart keeps downside favored as the price is below cloud and below Tenkan and Kijun Sen lines, and of course the Tenkan Sen faster moving average is well below the slower one, Kijun Sen, at currently at around 159.40. Near-term Ichimokus are also holding a negative tone. Initial recovery signal seen on the break above the Tenkan Sen. Still a lot of work required to improve the structure. The Kijun Sen is at 157.50, while break above 4-hour cloud that coincides with our barrier at 158.00 is seen as a break point and a signal for some stronger recovery. Until then, of course, the bearish tone would keep focus and would favor the downside levels at 156.30, 156.00, and 155.30, 155.00, our next downside targets. Dollar yen is in the near term consolidative, I would say, rather than corrective mode of a recent peak at 94.02 posted yesterday. Unobstructed larger picture uptrend is still fully in play despite screaming indicators in the well in the overbought territory. No any signal of any reversal seen yet on the larger picture hourly structure. So far the dip found the support at 93 around 93.30. That marks approximately 23.6% Fibonacci retracement of the uplift from 90.73 to 94.02. Also, the dips were contained by ascending 55 days exponential moving average. So far, we witnessed the basic attempt here as the price moves higher, 93.72 currently. Focus again towards 94.00. In case of any extension lower, the initial support is now at 93.30. Then we have 93.17, 93.00, previous high of 4th of February, and 92.76, 38.2% Fibonacci retracement. At this point, I would say that any only break below 92.00, that marks approximately 61.8% retracement of the latest up leg, 90.73 to 94.02, would have more significant impact on the current bulls, and in my delay bulls in favor of some stronger corrective action that would signal temporary top at 94 and allow for some deeper reversal. The 92 support is also reinforced by 4-hour ascending 55 days moving average. It seems quite unlikely at this point, according to the current situation in the technical outlook, that any stronger dip could occur, but overextended conditions, as I mentioned on the daily chart, do not rule out this action. And finally, dollar Swiss, that is consolidating recent losses. Basically, it's again attacking the lower boundaries of the near-term consolidative range that is marked by 90.54 on the downside and the 91.50 on the upside. We're talking about 100 pips consolidation following bounce of 90.20 fresh low posted the last Friday. Rather neutral, still neutral tone on the hourly chart, with slightly being aligned towards the downside on the recent move lower, while 4-hour indicators seems to be again losing traction as the recovery attempt yesterday's bounce above the range, previous range tops at approximately 91.20 zone, stalled at 91.50, where the descending 55 days exponential moving average of the 4-hour chart limited upside, keeping the underlying bear trend as shown on the daily chart still in play. However, it's important to point also that repeated dojis on the daily chart has now show the indecision as the market dipped as low as 90.20 on its strong down move from 2012 peak at 99.70. We're in the down, basically the pair is in the downtrend since end of July, 22nd of July 2012. This was the peak at 99.70, and since then the pair is in descending mode. It's important support here as we have the previous lows at approximately 91 zone from period April and basically from April 2012 when the last time traded at these points, and of course denting the weekly 90 days moving average that is currently at 91 zone. This area offers good support for now, and currently indecision is seen as shown on the repeated dojis in past couple of days. But however, the negative tone that still dominates on the larger picture still sees the downside favored unless we see bounce through minimum 92.00 that marks 50% of the down leg from 93.87 to 90.20. More focus will be kept on the downside, and key support 90.20 and 90.00 would come under increased pressure, break of which is expected to open a further extension lower down towards 89.30 and 89.00, seen as the next downside target. At this point, we're still in the range, and the key points in the near term are at 90.20, 90.00, and on the upside approximately 92.00, seen as the break points of either side. But as said, prevailing negative tone still keeps the downside favored, and any recovery above 91.50 current high should in any case stay so far for now capped by approximately 92, possible extension to 92.50, but sustained break above 92 and regain of 92.50 is to signal near-term base at 90.20 and allow for some stronger corrective action. Otherwise, focus remains at the downside. And from the commodities, yesterday's bumpy ride of the crude oil before and after the release of crude oil stocks brought some positive tone back in play as the oil price dipped from approximately 97 down to 95, tested our key support, and a quick recovery higher, showing that bulls still hold enough power in order not to break the key support and the break point at 95 zone. That would be signal for some more significant corrective action of the steep rally from 85.20 low of 11th of December 2012 that peaked at 98.22, holding above 9. Must say that 95.50 support has been taken out, and the 95.00 tested, and the quick recovery higher up to 97 level now sees potential for a further consolidation, possible recovery up towards 98.22 recent high, and the strong barriers that we have at 98.27 and the 98.54. Currently 61.8% retracement of the latest down leg from 98.22 to 95.00 keeps the upside protected. We need to see the break above this level to confirm the recovery. Higher pointing, upside pointing indicators on the 4-hour chart are now supportive, but a break above this level is required to confirm, as MACD is still in the negative zone, holding below the midline, and some loss of momentum is evident at this point. Loss of failure to break basically 97.00 would still keep pressure at the downside as part of the larger down move, while break above 97 is to open 97.50 approximately, which is 76.4%, and then focus up towards 98.22, 27 previous highs, and then we have 98.54 that marks 61.8% Fibonacci expansion of the entire rally from 84.05 base of July 2012. And quick look at the gold before we conclude pardon the session. Again, some positive tone has been re-established after yesterday's dip. Lower found support just above 1666, 5th of February spike low 1668, and then bounce higher to 1681 so far, approaching again the upper boundaries of the recent range, keeping the near-term tone still aligned towards the upside. Anyway, as we are still in the range trading, we need to see the break of the upside barrier, which is approximately 1684, in order clear break above this and close in order to confirm the resumption of the broader recovery from 1651. A positive tone still seen on the 4-hour chart favors the upside at this point. Similar is the situation on 1 hour, but it seems that the price is again losing traction. Most likely the investors are awaiting the release of today's central banks to get some more clear picture, and most likely we are going to see some stronger corrective action. Break above either side of the range, which is currently the upper one is in the near term focus at 1684, or downside one at approximately 1660 is required to give us the fresh direction for the yellow metal in the near term. And that's all for today, Thursday, 7th of February 2012. I would like to invite you for tomorrow's session, which is at the same time at 8 o'clock GMT, 10 o'clock local Cyprus time. I would like to remind you about today's number of important releases. Keep an eye on this, as this could be a significant market movers. Wish you a nice day, of course, and very good and profitable trading. Good luck.